Thanks a lot for coming here and joining us. We'll get started right away. While the topic is something I'm pretty sure you're all aware of, I'll just quickly set the context for both the valuable and esteemed guests on this panel. Um, Currently, as we all know, the Indian real estate growth and mobility and infrastructure has been all-time high. As a country, being a developing nation, the way we have grown our infrastructure in terms of road, transportation, projects are, I think everyone has seen for the first time the scale that we are seeing right now. I firmly believe the next 10, 15 years gonna be more different. And as a country, we may need to create more diversification across different mobility options. While we were discussing at the backstages, and Vinod and Debnil has a very eloquent pointers that how we can mature the different asset types. So currently, what I have seen in the Indian market, uh, the way things have grown in any industries has been always fueled by lenders. So if you see the construction equipments or commercial vehicles, this segment is being owned by a player like you, correct? And an inclusion of these, I'll say informal folks who are trying to get into it to become a formal economy, they always tend to look up to NBFCs like you, correct? And that's where the inclusion happens, and we all know. So I'll start with the first pointer, and I would love to you to set your pointers on this topic while I can go on the questions, that what you feel about the problem statement right now, where we are right now, and what are the opportunities that we foresee in near future. And based upon that, we'll just get started with the quick round of the questions. So over to you, and then we'll start with Vinod.
Yeah, good evening. In fact, as Paritosh said, in fact, we are in the wrong time right now. During the lunch time, it's always difficult to, kind of pass through your messages. But nevertheless, if you look at CE and CV industry, kind of it's directly proportional, or you can say directly related, correlated to GDP growth of an economy, right? Now, if you look at that entire this thing, today, logistic cost in India is approximately 10 to 11% of the entire GDP. If I compare this thing with any other developing or developed economy, it is approximately to the tune of 5 to 6%. Now, the inefficiency play is approximately around 6% to 7% in this. Right? And why I'm quoting this thing is very, very important in the sense like, if you look at the logistic cost vis-a-vis GDP is directly proportional to how fast you're moving the goods from manufacturing to the aftermarkets, to the consumers, right? And this entire play is basically your loading, offloading, transportation, and other things. Now, once the good starts moving faster, the CV industry comes into play. For moving things faster, you have to build the infrastructure. That is where the CE industry comes into play. So that's why if you look at these particular two industries are directly correlated with whatever the government is trying to build in this, right? So if you look at all the particular, kind of initiatives under Gati Shakti and other things, it's basically to impact the logistic cost that is getting incurred in the overall final delivery of the goods, right? And it's not only, another part is something like, it's not only, when we look at, kind of commercial vehicle and construction, always our, kind of thing comes in on the commercial vehicle and goods transportation through roads, right? But if you look at the infrastructure that is getting built today, it's not only roads, it's the DFS also, the direct freight corridors, right? You have the, kind of river linking projects which is coming in, which is basically creating the river ports and other things. So also creating a multimodal transportation system which can bring in the overall cost of transportation to the last mile is also one of the things which is going to play a major role in boosting the kind of final play in commercial vehicle and construction. So with this particular thought, I just want to pause on that to keep you on this particular thought. And we will kind of try to correlate every thought of this particular industry from here, so that we can look at the larger picture and start correlating that what is happening and why it's happening today.
Thank you, Debnil, for putting it so eloquently, and thank you for setting this backdrop. I'll come to Vinod because with Vinod, I've had a multiple interaction earlier, and we've had a very uh, detailed discussion on how we can change the way data works. So Vinod, again, would love to get your 2 cents on this problem statement, as I mentioned.
So before that, see, lending to CV and CE, there are three things which holds true. One, it is operationally very complex. Two, it is very field intensive. And three, none of the large lenders will lend to them, right? So I think there are like approximately 12 million commercial vehicles currently plying. What not many people know is 70% of this vehicles are the excess of 5 years and above vintage. And banks and OEMs would typically play around the 0 to 4 years where they find it very convenient because it is a new asset. Shriram comes into play only after the 5th year. So we had to crack the code on how do we lend to a 5-year and excess and a 10-year and excess vintage vehicles. So I think that has been actually become the strength of Shriram because we've identified the asset class who would own up to a so-called second-hand CV or a C, exploring that market, creating a data set and data pools where we can build models to understand these customers better. And that is why I think we have a pretty large market share inside in these segments. So that is the segments we play in, and we are pretty confident on how this segment is also going to grow into, adding value to the entire value chain. Right? So that's where we stand.
Jump directly to the questions now. So, Debnil, the first question, how has a deeper visibility into the fleet and contractor operation changed the way NBFCs assess risk and design CV&C credit products? Would love to understand a very candid view on that, and then we'll come to Vinod for the next part.
Okay. So, let's talk about a very broad level data on this particular part of it. Now if you look at in a CV or a CE industry, what you're trying to do on the credit assessment side of it. One is your customer risk, another is your asset risk, right? And the third on the play is basically the utilization risk that you talk about. So when you talk about an asset risk, you have multiple data sets which is available today. Like your insurance data, residual value data is available. You have, the accident data and other things that are available. Then over and above that, you have a GPS data which is available in the sense that what is the utilization which is happening for various set of, vehicles. Like a, small commercial vehicle, large commercial vehicles, and so on and so forth. Similarly, you have a e-way bill data which is available, right? So what is the inward e-way bill? What is the exward e-way bill? That is also available. Third set of data which is available is the FASTag data, right? So in the FASTag data, you can again multi-layer that particular data based on your small commercial vehicle, light and medium commercial vehicle, and the large commercial vehicle. So you know exactly that if you dovetail this particular data with the e-way bill, with the FASTag data, and the utilization, you more or less get to know that what is the kind of movement of goods that is happening in each and every part of it. That solves the problem of utilization risk. The second set of data which is available to you is basically, from the bureau, from the bank and other these things through the APIs and all, which is basically gives you the intent of that particular customer, right? And the third set of data is basically the identity set of data, right? Now, if you club it together, what used to happen earlier, it used to be a lot of paperwork, a lot of, going through the data, churning it across, putting it across in a kind of a format, then taking a decision on that. Now, most of the time what happens is, if it's a standard assets, it's a standard product, it goes in through a particular BRE, which is a function of these particular sets of data. Hence, the, the credit underwriting processes and other things are changing to that extent.
I think, conventional data we all are aware of, but I think thanks for putting that perspective for alternative data, which is as powerful as a conventional, if you understand the right segment, right data sets, and how should you leverage it. So thanks a lot for adding that point. So coming to you, Vinod, as a group Shriram, correct? As you mentioned rightly, so you touch the asset at that point of time when nobody is taking the risk on it, which really creates a very important question that as a NBFC, from a point of view of Shriram as an NBFC perspective, how does the value chain data influence the capital deployment decisions in an asset-backed lending?
See, specific to CV and C, gone are the days where you could derive what you can lend basis a borrower's balance sheets. It's moved on to what Debnil said. It's about your asset intelligence and market liquidity. Those are the only two factors which will eventually define how much can you lend. So there are only two layers to this value chain intelligence, right? So one is obviously the asset. The asset, what is the OEM? What is the asset? What is the vintage? What is the decay curve? Typically a depreciation value, right? And what is the market use case? All these would feed into a model which can help me derive an LTV, tenure, and probably a dynamic pricing. Can I bucket these customers basis these into different risk buckets and define a dynamic pricing, because we understand that there cannot be one size fits all, right? So the entire operating economics is built in a way that my branch staff is able to derive an income into a window, a band, and overlaying market intelligence on it. I'll define market intelligence to you. Market intelligence is, traditional buyers would define income basis, I think Debnil mentioned dealer invoices, or age-old static depreciation tables. See, we also use that. But there is something very interesting that we do over and above it. We run the country's largest commercial vehicle auction platform called Automall, Shriram Automall, which brings in thousands of buyers and sellers onto a singular platform and lets them exchange, do a transaction. Imagine the amount of data that I derive out of it. What are the current pricing metrics, which is currently asset to price to market? What are sunrise sectors? Which are the sectors which are currently booming? Which are the ones which are under stress? What are the socio-macroeconomical cycles which impact a buying of a second-hand a CV or a CE? So this kind of information, I don't think you would be able to enrich your data with through any other model. So my asset-backed theory of impacting LTV, tenure, and pricing, overlaying this with this market intelligence, gives me the actual strength to push forward, and also gives me a complete control on how much to lend, what quantum, at what price, to what extent, and how do, whenever I wish, I can also reprice whenever I see delinquency raising or everything. So I kind of, have derived guardrails on every parameter that is inside a purchase and a sale of a CV and a CE.
Well, completely amazed. You solve the value chain with your own marketplace, and enriching data from that really gives you an unfair advantage, I'll say. Why I'm saying unfair? Because you thought through that, because resale value in that segment plays a very important role. And as you mentioned rightly, so that in the micro segment, how would you assess that dynamic change of resale values? So that's a great insight that we've got today. Coming back to I think the second round of questions, again, I'll try to be as candid as possible. What role do flexible usage linked repayment structure play in maintaining credit health across volatile infrastructure cycles? And we have seen, I think, being in India, I think we've seen multiple volatile cycles in India. So would love to understand your perspective on the same.
Okay, in fact, this is a pretty good question in the sense, like, as commercial vehicle and construction equipment normally goes through a particular cycle. It's not only economic cycle, payment cycle, and it's directly related to the GDP and other things. So, in fact, Vinod, in his explanation, he mentioned three things, basically, if I have to summarize. In any asset life, what happens is there are three, one thing is your economic value. Second is your commercial value. And third is your residual value, right? So if I add up these three things, that's the total value in a lifetime of an asset that you can rip out of it, right? That you will be able to take out of that particular asset. Now, if you look at, kind of every time what happens is, once you're funding a new asset, you are funding it for 3 to 4 years or 5 years max, right? And the borrower is supposed to pay that entire value of the asset within 5 years. But as a funder, as a kind of a financier, we all know that there is an economic life which is there and there is a residual life which is there, as well as residual value and economic value which is there. Can we extend that particular thing over a period of time? Right? That is one. Second part, what happens is, if you look at the cycles, okay. Now let me give you a very, very practical example of a construction equipment cycle. During monsoon, this particular equipment doesn't bill, so the repayment capacity of the customer goes down. Similarly, during monsoon, the number of kilometers clocked by a commercial vehicle goes down, hence the repayment cycle goes down. His repayment capability goes down. Right? So can we match up that particular thing along with the repayment capability of that particular customer or the cash flow generation of a customer? Right? But today, if you look at the entire industry works as a kind of an EMI platform, right? And I'll tell you, kind of this particular thing, one of the innovations that I see is something like, if you look at anything that comes in the car market, auto market, gets adapted in the commercial vehicle market and goes up the chain, right? So if you look at any other, kind of today, if you look at most of the car market, there's a leasing market which is, kind of evolving, which is nothing but, kind of most of the players are playing across along with the residual value of the product at end of the period. But as commercial vehicle and construction is a complex, kind of assets, which is also dependent on the usage, application, and so on and so forth, this needs to be, kind of addressed. Once we are able to address this particular part of it, I think flexibility and creating a product can be done on the risk part of it.
Thank you, Debnil, on that. That's a very insightful data, and thanks for putting it so precisely. Coming back to Vinod, I think, Vinod, while you already touched base this point, but I just wanted to get a little bit holistic view of it, that how should a NBFCs structure partnership with bank, OEM, and marketplace to scale CV and C lending without compromising the risk governance? As we all know that we are in a phase of risk governance and regulatory stringent nature. So this is a very important aspect that I wanted to understand from you.
So in this segment, there are only 3 reasons because of which a partnership would fail. One, underwriting is outsourced. Incentives are on volume. And risk, nobody knows who's owning the risk. So these are the only 3 reasons partnerships would fail. But otherwise, partnership is a wonderful thing to have here. See, it's an age of marketplaces, right? So we do it ourselves, and we understand that people also have their own strengths. So we are very open about working with partnerships, but we keep these 3-4 things on check. No matter which partner, which OEM, which channel, we source, underwriting has to be in-house. Assess the asset, assess the borrower, look at the financial flows, do the entire due diligence bit, right? And we take complete pride in being a lot more physical also on field. We have a huge force deployed on field where we meet the customer, we assess, the entire valuation is done on ground and the due diligence is done. And the entire underwriting is centralized, where the data is fed from the field and it is done centrally. And no matter which partner or platform, they are only origination mechanisms for us. And the due diligence, underwriting, risk, collections, service will always remain with me. Right? Beyond that, yes, obviously, a few smaller things like incentives being staggered so that everybody has skin in the game, so that we understand that We also deploy a lot of BREs at the sourcing point so that we get the right lead in. And obviously, the last but not the least is monitoring it categorically, right? Instead of just doing a portfolio level monitoring, why not do it at a channel level or a partner level or an OEM level or an asset level, just to ensure that you have the right checks and balances in place, and any anomaly is immediately, any anomaly in the pattern is immediately spotted, and you can take measures. So we just want to be even there, while at a ground level, we also feed in a lot of intelligence, because we understand that an asset that is a user, a borrower, having an asset working in Mumbai corridor, and a similar borrower having the same asset working between a Bikaner and a Hyderabad, will have completely two different, economics. So that is where it all comes into play. So irrespective of where we are getting that borrower, we assess it very differently. We have a lot of in-house mechanism tools to ensure that we price the customer right, the quantum is also right, and we also monitor it post-delivery.
Perfect. I think what you've mentioned is the basics all are fundamentally right. Owning everything apart from origination, correct? Also, you're managing the origination channel, how the pitfalls are happening. So thanks a lot again for sharing this insight. Again, Debnil, I'll come to you on similar lines on the guardrails. So as CVC, lenders rely more on data, automation, and ecosystem partners. What governance guardrail are essential to ensure growth which doesn't compromise credit quality and borrowers' trust? I know that it's too much that in a one sentence that I've asked, but would love to get your view on the same.
Okay. So if you look at the data sets normally a financier collects, right? One is basically your own personal data based on identity data and kind of your validation data and other things. Second is basically the asset-based data, right? As Vinod was also talking about, kind of you also collect the data that which particular routes and other things he applies on, what is the frequency of the routes and other these things. And the third set of data that you normally collect is the financial data, which is his banking transactions and so on and so forth. What I feel is, kind of there are two things. Till such time you are using that particular all these sets of data for enhancing and supporting the customers, kind of business, it's in the right direction. But at the same time, obviously, data protection and data guardrails, kind of takes the first this thing on that. At the same time, kind of when you're utilizing the data, whether you're utilizing the data for enhancing and value adding to the customer, or there is a trust element in that, or either you're sharing that particular thing with a third party, kind of platforms or anybody else or not, right? I'll give you a simple example of this particular thing. Now think about a kind of a location data on a GPS data which is there, right? Now it can be used as two things, kind of one is the GPS data gets used as a kind of that what is the utilization of the vehicle. How many kilometers that the guy is running in, which particular routes he is running in, whether it's a fixed route or a variable route. It gives you a lot of insight on that whether the customer is stable, not stable, so on and so forth. Now think about it, the customer is defaulting or, kind of this thing. You being a service provider in between, if you provide this particular data to a financier where, kind of he uses that particular data for repossessing or halting his business. That is where the fine line comes into play, right? So there are multiple sets of data. Similarly, kind of the data that you are originating, are you, kind of sharing that particular data for cross-selling something? And subsequently, that particular vendor is going to utilize that particular data for any other usage or not. So what kind of sharing data agreements that you have with your partners also, that also is very, very important. Because that's going to ultimately, kind of hit your trust with the customer. So, and obviously, kind of the DPDP and other things has already come into place in that. But at the same time, these particular things as a business, as a commercial business, your customer trust and customer data usage, boundary is the most important part, what I feel. Hope that answers.
No, thanks a lot that you touched DPDP because I'm pretty sure that there's a lot of questions in the room and outside the room. While we talked about too much data, and that's where lot to be done. So again, I'll come to Vinod. While we're talking about a lot of data, and again, this question sort of talks about in few terms. So at scale, what distinguishes institutions that use technology to strengthen underwriting discipline from those that unintentionally introduce new systematic risk? While nobody wants to do it on their own, but sometimes to do something which is not basic fundamentals of underwriting, because I firmly believe, and everyone believes on the dais that lending is a business of collection, correct? So would love to get your perspective on that.
So lending is a business of being in risk, right? So see, lending is hugely commoditized. The only distinguisher that you're asking for is policy and underwriting, correct? So you can always increase LTV, give higher funds, you can reduce rate of interest. This is probably you can scale a bit here, but this is definitely a recipe to fail fast. So we understand that. So we put all our onus onto the policy and the the main differentiator is how you underwrite. So 3-4 things that we always try to do right. One, set up EWSs, right? So a lot of warning signals that we always deploy. So what are our overheating segments? So where all are we seeing that some sectors are specifically not doing well? So where can I reduce exposure? Where can I open up sectors and try and lend more? Where can I take more risk? So these are like a panel of switchboards which we keep course correcting. So we don't take calls over a course of a year to change track. So it's like continuously monitored and tracked and altered underwriting and policy changes that we do every month to ensure that we are on track with how the market is turning. Secondly, most important and crucial is the portfolio management. I think I spoke about it earlier. While I told you we do a lot of OEM-wise, asset-wise, we also do vintage buckets. We do geography-wise divides. We do risk segmentation-wise understanding on how collection is faring. So we have broken down portfolio into so many smaller micro segments that we typically have our fingers on every possible scenario that we could think of. So any smallest change in any of these micro segments, we understand can probably have a ripple effect here and there, so we can take corrective actions then and there. While I told you about Automall, one thing I think I missed is my feet on street, my field staff. These people also, there's a huge reverse feedback loop that I close in with these people on the field. I have a huge existing borrower on field who are in constant touch with my FOS, and these people give me so much of reverse feed. You spoke about residual value. These are continuously altered, altering parameters which keeps happening with the CV and CE segment. So unless these people give me a reverse feed on what exactly is happening there, I would probably be only sitting and doing a lot of work on the data, which can probably give me a certain headway, but probably will not complete the cycle for me. So this reverse feed kind of closes the loop for me, and that is where I feel that we have kind of created that entire guardrail system of having every possible scenario covered.
No, the very valid point, and thanks a lot for touching base the human point. I think while we talk about too much data and now AI and whatnot, but having a reverse feed loop from a human who has been so much loyal to our organization for a long time, and obviously understanding customer pain better than C executive level folks, correct? So getting his loyalty and data getting into the system in a reverse loop really helps us to unlock the blind folds and blind spots that we have in our daily decisioning. So on this note, I think we'll be closing this eloquent discussion on such an important topic. I really want to thank Debnil and Vinod for being so precise and at the same time touching base all the pointers in a very holistic manner. So thanks a lot everyone for joining us in this gathering, and have a great day ahead. Thank you.
Thank you
Thank
so
you.
much, gentlemen. I would request our moderator, Mr. Paritosh, to please felicitate the speakers. It was a wonderful trilogue in no particular order. Can we please felicitate Mr. Debnil Chakravarty, CEO, IKF Finance Limited. Ladies and gentlemen, can we give them a huge round of applause, please? Then Vinod Kumar, Chief Digital Officer, Shriram Finance Limited. Gentlemen, if you have any questions, the speakers and panelists are available to address all the questions. Please meet them